Thanks very much. Hi, so I'm here to talk about some fundamental changes we're seeing in the financial services ecosystem and the enormous consequences they have for everyone. For over 20 years now, there's been a shift in banks and other financial institutions to greater and greater centralization. This accelerated from 2000 onwards as banks rushed to move a lot of operational functions to low-cost geographies. While this did indeed reduce cost in many cases, it also increased bureaucracy. And as a result, many banks have found their rigid internal processes and systems struggling to adapt to the challenge from disruptive financial institution players like challenger banks, digital lenders, and other such companies coming into their markets. To become more nimble, they've been forced to decentralize, pushing decision-making down in the organization and granting greater autonomy to their various divisions and regions. Banks have also become somewhat humbler in their ambitions. At one point, the end game for every bank was to grow large and become universal, providing a full suite of products and services across retail, commercial, and investment banking. However, the market only contains room for a fixed number of behemoths of this kind, and many banks that previously sought to be universal have suffered as they found it very difficult to compete across all these different fronts. I mean, you can't be good at everything. So you've seen, for example, Deutsche Bank retreating from their desire to be an investment bank, and other banks succeeding by focusing on a particular vertical niche where they have special expertise. So for instance, OakNorth Bank just does SME lending and takes retail deposits, and has been very successful by maintaining this narrow focus. Finally, I'd like to focus on the move from bank as monolith to bank as ecosystem. Where previously banks would shun any technology they didn't build in-house, they're increasingly bringing in vendors as partners to deliver an overall solution. The rise of software as a service and cloud technologies have reduced the cost of many of these types of external services radically and expedited this further. And a move from monolithic IT architectures with a few large pieces providing all the functionality to microservices where the functionality of the system is dispersed across a swarm of lots of small services. Well, that's shown a method that you can do this type of change. Behind this shift lies an acknowledgement that banks already have a lot of experience dealing with a complex internal IT landscape. So they may as well embrace the Darwinism and dynamism of this ecosystem approach to pick the best vendor of each service and end up with a set of partners that suit their needs best. You know, a banker put it to me recently that he said, we realized a while back that we suck at building new things, but we're pretty good and we've been forced to become great at integrating what's already there. So let's take a step back and lay out the role of all the players here. So the needs of the banks and their customers drive this ecosystem, and ultimately they pay the bills. Their goal is to build a set of systems that are going to allow them to have a compelling suite of products that they can offer to their customers and a competitive advantage over other banks. They're in a continuous arms race with their competitors to innovate as a new generation of customers are demanding, products and services that are ever more tailored to their specific needs. These banks are facing continuous pressure to reduce cost while also fighting for talent. Whereas 15 to 20 years ago, if you were a software engineer, one of the most lucrative career options around was to go work for a bank. Nowadays, they fight for entry-level candidates with, big tech firms, and many of their experienced people want to leave to join startups where they might do more interesting and meaningful work with greater personal impact. Regulators set the rules of the game. They want to have a healthy financial system, and the only way that we know of to achieve this is healthy banks. However, part of their mandate is to ensure competition and maintain resilience, which means preventing banks from becoming too dominant in the economy or too systemically important. They want banks to be successful, but not too successful. Investors supply the capital and back their portfolio companies to achieve escape velocity and exit. Whereas the old recipe was to back a small number of businesses with hyperscalable models in the hope that one of them would be successful enough to compensate for all of the inevitable failures, We Company, Uber, Blue Apron, and other recent examples have left investors with a conundrum. How can they find businesses which still have the potential for an explosive upside, but also have a reasonable path to profitability in the short to medium term? They want to back the next Amazon, not the next Uber. Academia supplies a lot of the ideas and people. They want to collaborate with banks and fintechs and other startups for sponsorship, and also provide test cases and problem statements for their research. And finally, we have the startups, who disrupt the status quo with innovative products and services. By virtue of being small and unencumbered with legacy technology, they have more freedom to experiment than a typical bank would have, and therefore are able to adopt ideas from academia and elsewhere into practical use and build better versions of technology that was pioneered first at banks. A typical startup is a mix of young optimists fresh from college and industry veterans determined not to repeat the mistakes they made at previous institutions. So you can see how this dynamic plays out. Some players have multiple roles. So you've got banks that have a venture investment arm. You've got startups that are both a bank and a provider of services to banks, and so on. So how are each of these players reacting to these shifts? Well, banks are adopting a number of different strategies. Firstly, we've seen some banks experiment with creating their own digital brands. After all, if it's too difficult to change your existing mothership bank, why not start a new bank? The idea here is they can attract customers who might otherwise go to a challenger brand and experiment with new ideas and technology that eventually might rejuvenate the parent bank. So this approach was pioneered by Bank Leumi, for example, with Pepper, but we've seen it repeated around the world with a lot of different banks taking this approach. It tends to be somewhat of a hedged bet. As a de novo bank, the digital brand has room to experiment without legacy and with a relatively low cost of failure. If successful, the parent can move customers and services onto the new digital platform once it's been fully tried out. Alongside this, adopting a more flexible internal architecture encompassing cloud and microservices can bring the power of the ecosystem to bear within a bank. Individual pieces can be outsourced, provided by vendors, or developed internally, and the services can be improved and partners replaced if needed over time on a continuous basis. In the 1970s, Fred Brooks, in the Mythical Man Month, said, "Build to throw one away, because you will anyway." That advice was always simplistic, but it contains a kernel of truth. You really don't know enough about any kind of complex problem in order to design the perfect solution up front. You really need the experience of trying to solve the problem yourself to actually figure out how to solve the problem. And therefore, your solution needs to be able to evolve over time as your understanding improves. Microservices make this a practical reality by providing a means whereby developers can build for replaceability. The cost becomes low enough that they can throw not one, but multiple services away and iteratively improve the system in time as it's in use with relatively low risk. As they adopt the ecosystem approach and start to work with partners, banks need to wrestle with some important questions. Which parts make sense for them to build in-house, and what would be better acquired externally? This leads to other questions of comparative tech advantage, and the bank ultimately needs to figure out what they're actually good at doing. There's also the option of co-creation, where a bank works with a startup to create something together. But that leads to its own set of complex issues. Who owns IP? How does it get brought to market? Will other banks even buy a product that's been developed by a competitor? How do they ensure governance of the startup without losing the dynamism that they wanted from a startup in the first place? What about people? There's all kinds of complex issues to work through if you do this kind of co-creation thing. The skills needed to thrive in this world mean that banks will need to incentivize and hire people differently. They probably don't need quite as many general developers. A lot of the manpower will be supplied by the ecosystem eventually. But they will rely even more on developers that have niche expertise and people with good skills in evaluating partners and operationally maintaining these kinds of complex systems with multiple internal and external services. Rather than being incentivized to grow their own internal IT architecture and their big internal empire, IT managers will need to be rewarded based on the overall success of projects that they manage. Done right, this should increase alignment. Regulators have a positive role to play here, but have to give considerable thought about how to accomplish their goals indirectly, since they're now dealing with an ecosystem of partners, not all of which they have direct influence over. They need to be nimble to make sure their regulations are able to have the desired effect, but at the same time do not stifle innovation and prevent developments which might help consumers in the wider financial ecosystem or drive innovative companies out of their jurisdiction into other lower regulatory environments. Investors are still figuring out how to react to this. In some cases, for example, SoftBank with We Company, they have doubled down on existing positions and are clearly intending to just wait it out. But every dollar that an investor puts into their existing portfolio to provide additional runway is a dollar that isn't funding a new company in the all-important stage where they're struggling to attain viability. And investors are potentially leaving opportunities begging if they sit on the sidelines for too long. Academia are probably the least affected by these changes, except there are opportunities for them that arise out of this shift. They can spin off companies to take a commercial advantage of these trends, even as they shape them with their research and other work. And just as they've done before in the biotech industry, they can potentially profit by backing startups that they spin out with early venture funding, increasing their reputation for innovation at the same time. Startups now need to focus much earlier on unit economics and proving their business model through revenue. To be attractive to investors, it will no longer be enough just to have smart people with good ideas or disrupt the user experience of an existing industry without changing the fundamental economics, the so-called Uberization. They will need to come up with genuinely disruptive innovation and then exercise discipline so they can take that and build a real business that works from end to end and proves their idea. Broad expansion and growth at any cost needs to be replaced by narrow focus and intense emphasis on execution to make projects successful. The move in the market to success-based pricing should lead to better revenues for those who are able to do this, but will require startups to put skin in the game, and so they'll make secure funding even more important. Burning through investor cash, thinking there will always be another round at a higher valuation, just isn't going to be a viable option anymore. It remains to be seen how some of this will play out. Will neobanks ultimately displace existing banks, or will neobank innovation gradually peter out as customer demand for an ever wider range of services and increased regulatory focus means that they will become more and more like the banks they were originally trying to disrupt, and their ability to innovate and their agility kind of fades over time? What about neobanks that are also attempting to provide services to banks? The have your cake and eat it model that, for example, we've adopted at OakNorth. Well, it's a little bit early to say for sure, but so far the signs are good. There seems to be market demand as long as the product offering cake is good enough. And being a bank gives some credibility that a regular tech vendor would not have. The key here is to delineate clearly so that you're never in a position where the bank is competing with its own platform customers. So what risks and opportunities remain after these trends have played out? Well, the biggest risk is to choose the wrong partners. No one wants to invest the time, effort, cost in a project that fails or a partnership that doesn't deliver. As a result, some banks are taking a wait-and-see approach. Maybe they're doing a digital transformation or starting a neobank, but they're really just watching their competitors with intense interest in the hope of gathering more information prior to making a full commitment and hopefully backing the winner after the whole shakedown has happened. This strategy risks the bank falling behind bolder competitors in the market, and it risks startups failing because they can't get any of their partners to fully commit. The opportunity for a bank is to get in with a startup early enough to influence the product roadmap so that they can make sure that they get the outcome they need. Because customer number 1 is always going to have much more leverage than customer number 20. And if they can deliver truly disruptive products and services, then all their competitors will be rushing to catch up with them. So the best move is to pick some partners and go all in on their success, even if that means committing earlier than feels comfortable and enduring some short-term pain because some of the tech is going to be built in flight. They need to be fully invested in the success of their chosen partners. So for banks, that means a change from trying to reduce vendor costs no matter what, to a model where they structure projects in a way that enables vendors to be successful in the long term. They need to collaborate on a business model that makes sense for everyone involved, which often means some success-based pricing, capping the downside risk, but maybe paying away more if the project ends up working out well. While investors are rightly frightened of being burned, there is also the risk that they miss out on early investment in a startup that ends up being a crucial part of the eventual ecosystem and powering a number of banks. If they wait too long for a company to show a profitable track record, the profit could mean that that company doesn't need additional investors after all. The right move for them is to focus on areas they really know and understand and back their own expertise and judgment. to make early calls about companies that have a genuine chance of achieving long-term profitability. It won't be possible to just follow other investors into future rounds because these profitable companies might not need a future round. It may also require patience because in the next couple of years, the IPO market's going to be pretty thin. I mean, 2020 is a US election year, and obviously the outcome is going to be more than usually disruptive. Finally, the ecosystem approach means not all the money to be made in banking is going to be made by banks. And investors might actually be better off, rather than backing a challenger bank, backing a SaaS company or someone else who's providing services, platforms to banks. It's a famous truism that people need banking, but they don't necessarily need banks. Just as we're in the middle of a transition from monolithic banks to bank as an ecosystem, we can expect more radical changes are on the horizon. But there are also great opportunities in these changes, and those who play to their strengths and read the situation well should benefit from this shakeup. Thank you very much.